Alexandria was started with the important mission of providing unique infrastructure solutions to the life science industry, one of this country's most critical industries, most innovative, and the one that really everyone can rally around as a solution to address the great challenges of disease, as well as the other great challenge of hunger. When we formed the company in 1994, we knew that there were 7 major clusters in the United States, including Seattle, San Francisco, San Diego on the West Coast, Cambridge, New York City, Maryland, and Research Triangle on the East Coast. And our job was to become a trusted partner to the life science industry in each of those markets.
For Alexandria, it's much more than just building a really state-of-the-art sustainable building. For us, it's about creating really collaborative and innovative ecosystems within our campuses. It's about having amenities and environments that inspire our client tenants to be productive, to be efficient, to be successful and creative, and to give them the best chance of recruiting and retaining top talent. Every detail on this campus was intentionally designed to foster innovation, to drive productivity, to enhance collaboration. That's what we at Alexandria care about. That's what's in our DNA.
This building is going to be more than steel and concrete. It's a life-saving cure for my kids. It's amazing to think about what's going to happen in this building. You will find a cure for my kids. You will. I completely believe that.
One of the research areas that we've been working on for a long time is a disease called CF, cystic fibrosis.
Cystic fibrosis is a genetic disease that makes the mucus thick and sticky.
And it affects, respiratory system, digestive system, being able to have children, how long they'll live.
It's a very life-threatening disease. It shortens their life. The average lifespan of someone with CF is around 40 years old. And it's particularly tough when you're younger. Vertex has been working for 20 years to try to treat CF at the cause. Our original building served us very well, but we had started to outgrow it. We talked to a lot of different companies, and Alexandria was the only one that really wanted to know about our story. They came up with this really creative idea that perhaps the building could kind of be laid out like human lungs.
We thought it would be interesting to design a building around the idea of breathing. What if the entry to the building was an entrance into a breathing space, and it flowed through the building and fed really the science. So the science became the lungs.
Walking into this building for the first time, you just get this wow feeling. You see the big staircase in front of you, you see the backyard behind it, and it just feels like it was designed for us and for us to grow.
As you're going through projects like this, you really talk about every single design element. It was better than any project I've ever worked on, honestly. We have put 14 buildings together for Vertex, and this was by far the most collaborative.
Something in this new space that we didn't have in the old space is a learning lab. And this is actually a collaboration with Alexandria because this is space that we are working together on.
They bring in underprivileged students primarily to see science.
And hopefully it inspires young people to think about careers in medical sciences in particular.
If our tenants are working tirelessly to cure diseases like cystic fibrosis, like Vertex, we want to work tirelessly to make sure that their environment encourages them in that pursuit.
We put them in a spot and said, don't worry about the facility. We're going to make that amazing and beautiful and fantastic. You worry about doing your job, which is creating cures, helping humankind. Let us do the rest of it. And I'm really proud of that.
I'm desperate to be a grandmother someday, and I know my kids will live long enough with the research you're doing that someday I will hold a grandbaby in my arms. And that someday my kids will take a drug that's made by you and they will walk out cured.
One of the things I'd like to see us do in this building is cure CF. We're set up in this new space to do it, and we hope that when we do it, Alexandria will be there to celebrate with us.
Well, good morning, everybody. Are there any dry eyes after the video? It's funny, every time I watch that video, it kind of goes right directly to the heart when you see a mother and her children facing a disease like CF and what Vertex has been able to do to extend the life of CF patients. Early on, it was a few years. Today, it may be as much as 40 years, and cure just beyond, I think, beyond the horizon. So we will get there, and it gives you a good interaction of how we look at our clients, look at ultimately the patients, which are the most important thing, which really drives us each day. So in this slide, I kind of like to start with this slide. We went public in 1997. We just celebrated our 25th anniversary on the New York Stock Exchange. And this was a quote that Jim Collins, the famous author and strategist who is known for his work in the Good to Great books, Good to Great, Great by Choice, and How the Mighty Fail if you don't conduct your business without ego. That's one of Jim's key lessons. So I want to welcome each and every one of you, and we're going to tell you a little bit about Alexandria today. And thanks to David and to Ron and everybody with Barron, and congratulations on getting back after COVID and on the 40th anniversary. So our typical safe harbor. So we are a one-of-a-kind, mission-driven company. We're the only public company that actually we created and grew, as David said, from a garage startup, $19 million Series A in 1994, today with a total enterprise value of greater than $30 billion. Before the markets started to tail off, we hit a high of almost well into the 40 billions. So we've come a long way in those few years. And our really mission is simple. We brought life science real estate from a very small niche to a mainstream asset class where today there's a scarcity of this assets, and many big investment groups, whether it be pension funds, sovereign wealth funds, other big investors want exposure to this niche. And we want to create and grow life science ecosystems in each of these clusters, really to what the Vertex example gives you is to ignite and accelerate the world's leading innovators in their noble pursuit, really to advance human health and nutrition. We'll talk much more about it. And early on, we felt that one of the key, I think, founding principles of Alexandria was to focus on clusters. Michael Porter, famous Harvard professor, wrote about clusters back a number of decades ago, and we identified the life science ecosystem cluster to be really made up of 4 essential elements. I went on. One is you got to have a world-class location. You got to have innovation, which is groundbreaking science. You have to have risk capital, and you have to have the talent that really drives that. And each of our markets really represent that. So if you look today, this is a really dramatic slide. Innovation really is a national imperative and must remain a national imperative today. There are 10,000 known diseases to humankind today, and less than 10% really have addressable therapies, and far fewer have cures. And it really is our mission and the mission of this country really to address those with the great scientific talent we have. And you just see some of the statistics that I put on the right-hand side of this. Every one of us, literally every day, has exposure to somebody who's got heart disease, cancer, any number of diseases. And now the big worry for the future is really the neuroscience diseases, and among them being Alzheimer's, which is a national tragedy. I think it's also fair to say that just talking a little bit of the kind of political side of this industry, many people have demonized the life science industry, pharma and biotech in a sense, because drug prices have seemed to be too high. And really that is a function of one's deductible and one's copay. And it isn't often said that, or often acknowledged, if you look at the entire healthcare pie, actually less than 15% and closer to about 10% are really the price of pharmaceutical products. And it's interesting to note the 2 main offenders of that are hospitals generally mark up pharmaceutical products that they give to patients about 10 times their cost. Isn't really known. If you get a bill, you're in hospital for a surgery and you go out and it's paid for, you don't look, but oftentimes hospitals have a 10x markup. And then also the middle group, the middleman between the manufacturers and the inventors and the patient, there is a whole stream of middlemen that take 40% of that price. So if we could solve those two issues, it would not be such a issue with people on Main Street. We view Alexandria as really being integral and essential to the rapidly growing area of mental health and addiction crisis. 1 in 5 adults today is experiencing mental illness, kind of an amazing stat, but not surprising after COVID. And 1 in 6, age 6 to 17, are experiencing mental health disorders, a real national tragedy. And I think the president had a great opportunity, but he missed it when he announced a couple months ago his famous moonshot addressing cancer. Although cancer, many of the cancer types still create tremendous impact on human health, over the last number of years, tens and tens of billions of dollars have been put toward cancer research, and we've made great strides in solving many of the cancers. Many are left. But I think what we haven't done as a nation is to get out there and put a national priority together to address mental health. And it would have been greater if the president had put this moonshot and the federal dollars toward mental health solutions rather than cancer, which the private industry is really addressing, I think, very effectively. Last week, we held a pre-Galian event here in New York, and we had Patrick Kennedy. We interviewed him. He has been a subject, his entire family, of addiction and mental illness, and he has become really the poster person for helping try to address this issue, to put it front and center, and hopefully solve it. Moving on, if I can get my slide going, there it is. In 1994, this was the first building we bought in San Diego, California, and today we're building a campus. One of the buildings is featured there. So you can see quite a change over the last 25, 28 years in design and kind of visioning. But this sits right on the bluff in Torrey Pines, overlooking the ocean in La Jolla, and quite a special place, and where many really great biotech and pharmaceutical companies do their great research. We're very proud, and this is a picture of our 3 main campuses in Cambridge, Alexandria Technology Square. These all sit pretty much adjacent to the MIT campus, which is the heart of the cluster there. And MIT, if you look at the products that they have commercialized through their translational research, since they were formed as an organization, they put out a booklet a couple of years ago, would be equal to the 8th largest GDP in the world. Kind of amazing. Alexandria at Kendall Square, another big campus. We bought these campuses, Tech Square in 2006 and One Kendall Square in 2017, redeveloped them, and now they're centers of great innovation. And then our Alexandria at Kendall Square, we entitled over about a decade and then spent about a decade building. So today we own and operate about 6 million square feet in the heart of Cambridge, and really known as the One Kendall Square area, where this is really the heart of life science research in the world. So Alexandria, when you talk about moats, Alexandria has gone from the one building I showed you today to an asset base of almost 75 million square feet. We have no public comparables. There is one private comparable that is out there managed by Blackstone, and I think their square footage is in about the 10 to 15 million square foot range. So you can see the size and scale of what we've done in all the major clusters. Seattle, San Francisco, San Diego, Greater Boston, New York City, where we sit today, Maryland, Research Triangle, and most recently, we've entered the Texas market. So that's a critical mode, is size and scale and just dimension. So one of the other moats that we have that is really irreplaceable and unmatchable and unassailable is we have over 1,000 client tenants, and nobody even comes close to that. And here are some of the brand names that we serve and are partners with. And we're very proud that last quarter we just reported our quarter toward the end of October. We had a very, very strong quarter, despite what the market says. We had, I think, all of our stats by analysts and investors would say we had a really outstanding quarter. And part of that is our leasing, 1.7 million square feet for the quarter alone. Almost 90% is driven by our own tenants. So we don't have to go out and put a for lease sign out or hire a broker. We generate almost 90% of our leasing through the tenants that we have. Kind of an amazing statistic, and one we're very proud of, and we have earned the trust, respect, and I think admiration of these tenants over a long, long period of time by delivering operational excellence and making sure these very sophisticated buildings don't go down. So this chart is, I won't get into all the details, but on the left-hand side, as I said, 87% of our leasing in the third quarter were from our own client base, and some of the stats about the health and strength of our tenant base. Almost half of our revenues are from investment grade or very large cap tenants, so we sleep well at night. And on the right-hand side, you see an extremely well-diversified tenant base by sector, including not only pharma, but life science product and service, public biotech companies that have approved products, investment grade tech companies, we have a number of those, and a big swath of institutions like MIT, Stanford, et cetera. So for investors like many of you who invest in the Barron funds, dividends are important, and they're important to us, and clearly we've had a history of solid, consistent, and wonderful cash flow growth. And so our current dividend yield is 3.4%, but over the last 5 years, for example, we've been able to grow that dividend annually at about 6.5%, and we're very proud of that sharing cash flow. We use much of our cash flow to reinvest in our business, and some of it we distribute to our shareholders, of course. Now another Barron, not Ron Barron, but the Barron newspaper, which you receive generally every Saturday morning, recently featured us and is attractive yield for investors, so that was a kind of a nice shout out. So we're very proud also of transparency and reporting, and we won the NAREIT, which is the industry, kind of the industry group made up of the companies and the ecosystem, National Association of Real Estate Investment Trusts, and we won the Gold Award 15, 16, 18, 19, 20, and 21. Not sure what happened in 17. And this year, I think they got tired of giving us Gold Awards, so they gave us Silver. It reminds me of the story. I have a friend who is a member of the famous Vintage Golf Club in California, and for 5 years he won the golf championship at the club each year. And when I visited his condominium, I asked him, gee, where are your awards and your statues? And he said, well, I won every year, and they asked me, don't come back next year because it's demoralizing for the other members that you've won 5 years in a row. So maybe this year, that's why we got the Silver Award. But our credit rating, we have a fortress balance sheet, which in these times you want to have. We're among the top 10% of all publicly traded REITs. We are an S&P 500 company, and our investment grade debt is highly rated. So when you look at fortress balance sheet, what does that really mean? So to us, it means a couple of things. One, significant liquidity. And that's really, really important, that you have access to capital immediately without having to do anything. That our debt has a remaining term of over 13 years, which is pretty long these days. Our average interest rate on our debt is 3.5%, and right below that, almost all of our debt, almost 96% of our debt is fixed. So we don't have, we aren't marked to market when the Fed, as they did this week, raises interest rates. We don't have to worry much about that. We have no debt maturities to 2025, which is great. We don't have to finance in an increasing interest rate market. And out of 127 publicly rated REITs, we've got the second best maturity profile out of all those companies. So a really great position to be in. And our net debt to EBITDA is about a little over 5%, which is pretty conservative. So I know Ron and his entire team pride themselves, and I saw him this morning being interviewed on CNBC, on long-term, really long-term performance. And if you go back to the slide that I put was our cover slide, and Jim Collins talked about superior performance, this is what I believe superior performance means. Over the last, in 20 and 21, which were the COVID years, our company was up over 45%. This year, for no good reason, we've put together 3 blockbuster quarters. We're down 35% because REITs are shorted and people don't like real estate because of interest rates, but they don't really look at the underlying companies. So over the last 3 years, our total return is a little north of 10%, so not as high as we would have liked it, but much better than virtually all of the other REITs out there. And we think that'll come back nicely. We think that's kind of a blip in the road. But this is really the important stat, because people shouldn't be investing for a month, a quarter, or even a year. But if you look, since we've been public over the last 25 years, our total return has been over 1,600%. And what I did here is try to give you a benchmark of other comparators. So if you look at Walmart, biggest retailer, 1,100%. So we beat them pretty darn nicely. NASDAQ, which is an interesting benchmark, 900%, beat them pretty nicely. Berkshire, boy, during this period, to be able to beat Warren Buffett, that's a heck of a thing to say, so I'll take that. The MSCI is the REIT index, so we've kind of blown that away by more than 2x. The S&P 500, which we're a member of, we've blown that away by over 1,000%, and the Russell 2000. So I think this is what really matters, and we feel like we've done a great job, great stewards of capital, and have, I think, delivered superior performance over a long period of time. Now, what's important to note, too, is our company's platform, our moat and our platform really are essentially supported by 4 key pillars. One is obviously our real estate and infrastructure, and I think I couldn't have said it better than the video we showed you on what it meant to Vertex, but more important to the patients who are taking CF drugs today. We also have a pillar we started in 1996, our Alexandria Venture Investments. We have on balance sheet about $2 billion in some of the most exciting companies. In 2003, we invested in Alnylam, which was a startup company. Today, it occupies hundreds of thousands of square feet in Cambridge and is a multi-billion-dollar company with commercialized products in the RNAi area. And in 2013, fortunate enough, I led the investment in Moderna, which was a teeny company then. And today, the history of Moderna. So we have $2 billion on balance sheet and about $500 million of built-in gain that we haven't harvested yet. Thirdly, corporate responsibility. We take this very seriously. I'm going to talk in a moment about some of the details there. This is a picture of Rob Portman at our grand opening. We partnered with Google to create the first campus ever created, which is a continuum of care, data-driven in Dayton, Ohio, which had the highest death per capita in 2017 when we launched this effort due to the opioid crisis. And it's the only continuum of care. detoxification for 28 days, but rather than kick you out on the street, we go through sober living, family reunification, job training, and job placement. It doesn't exist anywhere in the country, and I'm kind of at a loss why nobody has copied our model. Just, sad. And then finally, our final pillar is thought leadership. We do a lot of thought leadership programs. This is a picture of Scott Gottlieb, who many of you have seen on many of the news channels during the COVID years, was head of the FDA and a brilliant person, and who's written much about it. This year we did a major gene therapy conference. One of the key modalities for future treatment of rare and unusual diseases, and then we just completed one in New York City on autism. So we're very proud of what we've done in that regard. We have a number of great visionary campuses. You saw 3 of them a little bit by our slide on Cambridge. This is a good example of one we're building in San Diego right now, focused on scale, community, design, activation, and placemaking. And it used to be the 3 R's were writing, reading, and arithmetic. Today, the 3 R's for employers are return, or I should say recruit, retain, and return. And so these campuses are really created to enable employers to do that. However, our laboratories, as opposed to office, have operated 24/7 since the pandemic started, because you can't do science in your home. So all of our labs have been open 24/7 since the beginning. This is a picture of a part of a campus we're building for Bristol Myers in San Diego. We signed that lease, 427,000 square foot earlier in the year. This is going to bring together some of their greatest researchers in the cancer area. And Bristol Myers has been a client tenant of ours since 1998 in 6 of our clusters. So a long-term relationship, and you must say kind of a beautiful building it's going to be. We also this year signed a big lease, over 300,000 square feet, with Eli Lilly. David Ricks had just reported, and they have done a great job of managing their franchise over the past many years. This is a picture of their genetic medicine building, which will be on the harbor in Boston that we're building for them, and truly a groundbreaking building and design. We've had a relationship with Eli Lilly since 2008, and they're in multiple clusters of ours. This is just a quick slide on our strategic investments. We've been the #1 most active corporate investor in life science deals over the last 5 years, and the 4th most active in agri-food tech over the last 2 years, although we've had a long-term horizon investing in those sectors over many, many years. I won't dwell on this. This is a little bit about sustainability and some of the awards and mentions we've gotten over a long period of time. We're very focused on sustainability, and so are our clients. One of the sad parts is almost no matter, and I think certainly you'll hear more about one of the great sustainability companies in the world, Tesla, I think later in the day. But the sad part is the Paris Accords allowed India and China, which hold literally half the world's population, not to abide by those accords for more than a decade. And so much of what we do today is really offset by much of what they're doing over in Asia, which is kind of a sad situation. This is a great slide. It's a cutout of the corporate headquarters and R&D center we're building, almost 500,000 square feet in the heart of Cambridge for Moderna, powered entirely by geothermal. So this will be the most sustainable laboratory building ever built in Cambridge, and we're very proud of that. And then maybe to finish off, let me just highlight our corporate social responsibility pillars under that particular pillar. The ones on the left-hand side really are focused on our medical and agri-food efforts. In the middle slide, we have partnered with the Navy SEAL Foundation and work very closely with them and the Gold Star families and the families of deployed SEALs, so we're very actively involved. The slide below that, or the picture below that, is our campus in Dayton, which I just mentioned, where we partnered with Google. The next slide over, we've partnered with Mike Krzyzewski, Coach K, down at Duke, and for bringing Durham school kids through after-school programs to build principled leaders and character and get them into four-year colleges. And over the last 12 years, 1,500 students have gone through that program, and not a single one has failed to get into a four-year college. So you talk about impact. And I'm out of time before we go to Q&A, so let me just mention one of the ones at the bottom. You'll see a bunch of tents. One of the biggest problems in our society today in California, we're certainly seeing it in spades, is homelessness. So we're partnering with Google, and we hope to have a Dayton opioid-like campus for homelessness that we're going to unveil, hopefully on the West Coast over the next year or two, and something that no one has ever done before. So with that, let me finish. I want to thank you, and I'm going to head over and join the panel here. So thank you. David, thank you. Ron, good to see you.
Great to see you too.
So we have, that was great. Thank you so much. We do have time for one question. If anyone in the audience has a question, please just raise your hand and a mic will find you. If not, we do have a number that were submitted ahead of time. Do we have?
Gentleman. Yeah, they're trying to get to him.
Great. Number 3, please.
That was quick. I was wondering how you did year-to-date this year.
So as I mentioned, our total return this year is down 35% despite reporting 3 terrific quarters, but that's a function really of interest rates and inflation impacting the REITs in particular. It's not company specific. But if you look at 20 and 21, we were up 45% in those 2 years compared to the office index, which was down about 0.5%. So over the last 3 years, we're up a little north of 10%. So it gives you, but remember the chart I showed you is the long-term performance, which is really counts.
I agree totally. Thank you.
Thank you, sir.
Great. We do have time for probably one more. Number 2? Or, sorry, do you not have one?
Could you give us an idea of how you think the real estate market is going to be impacted by work from home policy?
Yeah, that is maybe the debate of the century here, or maybe not the century, but maybe the mini decade that we just started in 2020. I think work from home, it's pretty clear that you can't build a company, you can't build culture, you can't train people by having remote workers. And for us who operate laboratory buildings, we don't have that problem because virtually all of the scientists come in day by day and have been doing that throughout COVID. In fact, many of them have been working on COVID diagnostics, testing, therapies, and vaccines. But in the pure office sector, that's one of the big challenges. But I think most employers are I think today working on a hybrid situation, several days in, several days remote, but over time I think it'll become, hybrid will be with us for many, many years, but I think it'll be more in than less and less out.
Great. I think we actually have more time than anticipated. So again, if you have a question, please raise your hand, and someone with the mic. I think we have one up here. This will be number 2.
How do you justify your investment in things other than real estate?
Well, you know, that's a great question. Number one, if you look at the other pillars, venture, I'll talk about that. Corporate social responsibility, I think, is very important. We feel like we're in a unique position to do the things that we've done, whether it's with the Navy SEAL Foundation, whether it's with Coach K and the students, and then obviously on the thought leadership, putting time and effort in bringing important speakers and important topics to light. But on the venture side, actually, that is one of our moats. We started, when I started the company back 28 years ago, I was the only analyst, if you will, focused on life science together with doing real estate. And today we have a team of about 40 people doing that. But it's so important because we want to be able to choose, much like Barron, the Barron teams go and do deep research on companies. We do that too. That helps us avoid companies that aren't really going to be great companies. It gives us kind of the secret sauce and the special capability to underwrite our tenants, to underwrite the industry. And I mean, that's how we came to Moderna in 2013. No one ever heard of Moderna back then. Today, it's a household name. So that gives us, in my view, an unassailable competitive advantage against real estate people who don't know anything about the tenant base. That is, to me, a critical, critical part of what we are, who we are, and I think the success we've had. But great question.
Number 4.
Thank you for the presentation. You mentioned you're not sensitive to interest rate increase. Can you elaborate how REIT is not impacted by rising interest rate?
Yes, well, REITs are in general. We are not at the moment because, as I put up on the slide, we have no debt maturities in 22, 23, and 24, and the first ones we have are in 25. So that means for the next 2.5 years or so, and well into 25, we don't have any debt that we need to refinance in a rising interest rate market. So that's number one. Number two, it's important to say 96% of our debt is fixed rate debt, investment grade debt. So it's fixed at an average interest rate of about 3.5%. So many real estate companies have a large amount of debt that is variable rate that gets marked to the interest rates, whether it's, you know, monthly, quarterly, daily, whatever it is. We don't have that exposure. We only have about 4% of our debt which is variable, and that's pretty much of a rounding error. So that's been our defensive mechanism against rising rates.
Number 9.
Thank you. Could you address the risk of obsolescence in these highly specialized facilities you've built?
Yeah, that's a really great question, and that was the key question when we went public. Almost every analyst said, oh, you know, yeah, maybe this is an okay niche, life science, you know, maybe it'll be an industry. Back in the mid-90s, nobody knew. Today, I think Steve Jobs said several years before he had passed that the 21st century would be the great century of the intersection of technology and biology, and I believe that to be true. And if you look at buildings that we have built, they're actually specific to an industry, but the industry, as the pie chart indicated, is a huge industry, one of the biggest today. In fact, the industry holds $700 billion of cash on balance sheet today. But we have not had, our CapEx is lower than most other REITs. We have, the infrastructure is generic and it's reusable and releasable to this industry. Now, if you want to go and put a, you know, Carl's Jr. into one of the buildings, you have to do some things, but we're not planning on doing that. So over a period of 28 years, we have proven to the analysts and investor community that there is no real obsolescence in the infrastructure. Now, machines that are sitting on desktop, those are shorter term lives, you know, sequencing machines, things like that. But the basic infrastructure, which is the HVAC, the water, the gases, the air, all that, infrastructure, floor loading capacity, ceiling heights, that's all totally generic infrastructure. So we've proven that, and our CapEx has been much lower than office companies. So that probably is a great testament to the truth of that statement over a 28-year period. A great question.
Number 8.
Hi, good morning. I've seen some articles over the last week as it relates to the vast divergence in values between public REITs and private REITs. I was just wondering if you could speak to Alexandria's implied cap rate and how that might compare to the Blackstone vehicle you mentioned that also targets life science real estate.
Yeah, I'm not privy to their we're not investors, obviously, in their company, so I'm not sure I can give you their implied cap rates. But it is true that during the heyday of, till this market turned, in the life science industry, we saw the first move from risk on to risk off in February, March of 2021. That was our first signs. And I think over that time, the market has gone obviously to a much more risk-off basis. So cap rates were pretty low and still remain pretty low, and we have a scarce asset class, which is really good. Office is not scarce, industrial is not scarce, for example, but our cap rates have been maintained pretty low. I think interest rates and inflation have driven them up maybe over the last year or two. Maybe in our sector, maybe 7.75 basis points, maybe less than a full basis point, as we can see for Class A product. But I'm not able to really tell you on the private REIT side what cap rates are there. I do know that during the heyday of the bull market, private REITs were raising large amounts of money. Today, they're having a much harder time doing that.
Number 1.
As a psychiatrist, I'm impressed with your focus on mental health and homelessness, issues like that. The program in Dayton that you were talking about, I wonder if cost is the reason that it hasn't been replicated. And I'm curious about how that's been financed, as well as issues like homeless programs.
Yeah, so that's a really good question. I do believe mental health is in a sense the cancer of today, because it's silent and it's pervasive, and the numbers, as you know, are really staggering. So in Dayton, when we partnered with Google, their healthcare subsidiary called Verily, the deal was we put up the real estate funds to build the campus, and we ideated and kind of envisioned the campus to be that complete continuum of care. They put up money to help fund the operation. The operation is covered, and we have 2 hospital operators that work with us. So it's been funded out of funds from, we haven't put any more money in, Medicare, Medicaid. We haven't gotten any money from the feds or the state, but it's been operating funding. We're looking at a strategy to do more permanent funding because we think that's really important. But the real issue is there's huge amounts of money, tobacco settlement, the opioid settlements, and even the infrastructure bill that was just passed in Congress to the tune of $1.5 trillion. Why, and Rob Portman's been a great, the current senator, although he's stepping down, why the government has not put more funds into this issue. We're losing 100,000 Americans every year, or more this year than last year, to opioid addiction. 2/3 or 3/4 now caused by fentanyl coming across primarily the Mexican border. Imagine if we were in a war and we were losing 100,000 soldiers a year. There'd be people in the streets rioting and protesting. We don't see it. It's the silent killer, and God only knows why that is. But thank you.
So we do have time for one more. 10?
There's been a lot of talk recently about government coming in trying to control drug prices. Yeah. And so my question to you is, how does legislation affect your investments?
Well, that's a really good question, and one that is unknown at the moment. The drug price legislation, which enabled, there were some good aspects of it, but one that we think is not so good, and David Ricks, CEO of Lilly, has spoken about this recently, which gives the Medicare, well, first of all, maybe remember, if you look at the pie, 2/3 of people are covered by private insurance in the US, 1/3 are covered by Medicare, and there's about 8 to 12% who have no insurance. And so those hang out there to be dealt with. But in general, the 1/3 covered by Medicare, the recent bill said that the government Medicare could negotiate prices on certain products that have been on the market a while and that have gotten seasoned over time, and that will start in 2026. The sad part about that is, as I said, if you look at where I'm a manufacturer, I invent something, I'm Vertex, I invent a drug for CF, I sell it through the middleman who then sells it to pharmacies, doctors, hospitals, whatever it may be. 40% of that goes out the door to pharmacy benefit PBMs groups. They're kind of the middlemen. Why that takes place, I don't even know. The prior administration was going after that in a bill, but then abandoned it, saying it was too complicated to try to work through. I can't imagine why that would be the case, but nonetheless. And then you have, in addition to the PBM, hospitals who get drugs, they mark them up on bills, sometimes to the tune of 5 to 10, not percent, but times. So that's where people should be looking, how we can eliminate, foster innovation in the manufacturers, take out the middle costs, and make it more cost effective to the end users. To me, that's the system, not Medicare telling people we're only going to pay you for this or that, because ultimately that will not be good for innovation in this country. So that is something that we pay very close attention to.
And that's our time, but Joel, thank you so much again.
David, a real pleasure.
It's always a pleasure. Hopefully you've seen.
Great.